Welcome to the Daily Update, where I'll go over the action in the market for Friday, August 2nd, and we'll see how things look for Monday, August 5th. For those of you that watch this after the close on Monday, this won't apply to you, but this is about 12 hours later than I usually prepare and record the video over the weekend, and I post it right when it's available for members in the SPX Investing Program. And there was another internet throttle back where I currently reside, and I had like 0.25 megabits per second of speed for about 10 hours. And it just meant I couldn't update anything. So I'm quite a bit late with this if you are a member of the program, and I apologize for that. Let's see if we can go in and look at what's happening now. I do have the SPX Investing Program that I just referred to. For right now, it's still free. I'm going to be locking that down in August. There are links in the description below this video, and there's also a link that will take you to the website as well as to some videos where you can learn more about the program. And here's an email address if you want to contact me. Also, over the weekend is when I prepare all these outside videos here. Well, I'm going to be a little bit late with those as well, but all of the videos that I do point to the daily video. That's the foundation of the analysis and commentary that I do. And this switch that we saw in Thursday and Friday session, we saw it unfolding fairly well. You never know for sure what's really going to happen, but we saw the telltale signs. And if you watch the daily videos, you were pretty much prepared for that. Okay, let's go back and talk about what happened. We had a gap lower open. Now, we're going through this idea these days that maybe there's some economic concerns, that maybe we're going to go into a recession. We're starting to hear that a little bit more after the employment report came out. To be fair about this, the futures were tanking well before the employment situation report came out. So I don't know if I would put too much credence into that conclusion. Yes, it's something that we watch. Yes, it's something that could happen. But to reach a conclusion and to say that everything is shifting because of that, it's a little premature to do that. So we were down over 1% even before the employment situation report came out. And because it did come out negative, it didn't give any kind of a bounce to the market and things just kept going. So we gapped lower right at the open. We declined below S1 at 53.83. We tried to find support down at S2. Now these ranges were pretty wide because of Thursday's session, but we tried to find some support at 53.19. As the day went on, prices did stabilize right around that S2 level, and it looked like, okay, maybe we're building a base that we can come up out of, but we were not able to advance up off of R2. We did close slightly off of the lows. So there was really no effort to come in and do some buying. All right, so we were down 2.14%. It's the first time in quite a while we've seen more than a 2% move, either up or down, and we were above average with volume. We are negative now in the short and intermediate term. We've been that way all along. We were battling with the 50-period moving average. Now we're dealing with the 100-period moving average. We closed right at about that level of the 100 period. Is that going to provide some support? And the market is now dealing with, okay, are we going to switch our scenarios over and say, well, inflation isn't so much of a problem, but now what about economic growth? Can we freak out about that? If the Fed comes in and raises or lowers rates, why? Is it because they just want to help stimulate the economy? Or is there real economic weakness going forward from here now that the employment situation is looking to be a little weaker than what the market thought it was going to be? And of course, we live in a really crazy world right now where things happen really fast. So we want to keep an eye on all the different geopolitical concerns. There's an escalation of things happening right now in Israel that's kind of evolving more into a Middle East conflict, where Iran has actually threatened to attack Israel, which has never happened before. They've always done it through proxies, through Hamas and Hezbollah. We'll see if that goes anywhere. And so we're just dealing with all these different things, plus the whole political situation going on in the US. And things are pretty crazy right now and likely to get even crazier. We'll have to see what happens next. Some comments. We saw another broad-based decline. Amazon and Intel, which reported their earnings after Thursday's close, market didn't like that. And that's what was really dragging things down. Growth concerns, as I said, because of the economic report and this weak economic data that we saw, is starting to switch over to bad news is now becoming bad news. Where for a long time, good news was bad news was good news. This could be switching over to a different perspective now. Parabolic SAR. I've never seen, well, I haven't seen this in a long time. The parabolic SAR, it went positive after Thursday. Well, with Friday's decline, it switched back to negative. Usually once this signal is generated, it lasts for a while. But there's a bit of a discrepancy here, and I'll show you later on, where we've switched back to negative for the S&P. We have not switched over to negative for the SPY, which is the ETF attached to the S&P 500. And I'll talk a little bit more about that when we get there. And we're down to the 100 period moving averages. And we're pretty long now, again, with our extreme negative readings in the short term, with the Stochc RSI, the Williams percent R, the CCI 14 and 20, the stochastics in the short term, the force index, the slope oscillator, as well as the boom indicator based on 20 periods. We've gone quite a bit below the 20 period moving average. In the intermediate term, we have the rate of change going back 20 periods. That's one that we don't see an awful lot of. And then we're still extreme, even though it's coming down. When you look at the 10-day moving average of the new highs and new lows for the S&P, it's still giving a very high reading. Now, it could come down. It's a little bit slower, takes a little longer to reflect what's actually going on. But for right now, it's still extreme positive. So we're wondering now, are they going to even, what's the Fed going to do with interest rates? The market is expecting them to cut. And of course, over the weekend, you're probably going to watch other videos. You're going to hear all kinds of commentary. Everybody has an opinion. We'll just step back, take a look at things, evaluate them going forward, and then see what happens from here. But now it's 100% chance the market is banking on anyway that they're going to cut rates. Now it's like, how much? Is it going to be 25 basis points, 50? I even saw 150 somewhere along the line of point or 1.5%. My goodness. The dollar was down, which could have supported stocks, and interest rates are down. Look at this. This is also kind of maybe freaking the market out a little bit. We dropped below 4% after Thursday. We were at 3.98% with the 10-year yield. We fell even further to 3.79%, and that didn't really give any support to stocks. Are interest rates coming down because of economic weakness? That's what the market is thinking about right now. We're still inverted with those bloody yield curves, though. And we are negative now as far as sentiment. We went all the way from 40 after Thursday, which was a big drop in and of itself because we had been in the 50s, all the way down to 27 when we closed on Friday. And we are negative with our trend. The ADX, it's still below its moving average. It's trying to turn up, but it hasn't quite done that yet. And the red line is moving up, so we default to positive there. With the down day, we're negative, and I probably could have changed this over to mixed from negative. All right, or negative from mixed. So we got the non-farm payrolls. This was much weaker than expected, 114,000. They expected 170,000. Now, another thing to make note of is last time we got 206,000, and they revised that down to 179,000. So yeah, we're seeing the headline number here is showing some weakness. The private payrolls also way under what was expected. 97,000, they expected 153,000. Last time it was 136,000. Average hourly earnings up 0.2%, less than the 0.3% that they expected. We did see up 0.3% last time. Unemployment rate, this is what all the politicians and financial media, they're going to be talking about this. Ooh, 4.3%. I haven't seen this high of unemployment since I got laid off. So anyway, they expected it to come in at 4.1. And last time it was at 4.1. Now it's jumped up to 4.3. As I've stated before, I don't put a lot of credence in this. This is a headline number that people just like to use to manipulate things because there's so much craziness that goes into how this thing is calculated. Who knows? I mean, yeah, there are people that do know that the unemployment rate is a lot higher than what's projected here, but this is what the market reacts to. Average work week, 34.2, down from 34.3. Oh, my dream is to only work 34.2 hours a week. Last time it was at 34.3. Factory orders down 3.3%. They expected them to be up 0.4%. Last time they were down 0.5%. Okay. So the hourly earnings on a year-over-year basis are going down. Okay. That's not inflationary, but that could produce some economic concerns because people are bringing in less money. We still have inflation that we're dealing with. And instead of going out and buying that big flat screen TV, they have to wonder, okay, is it going to be hamburger or chicken at the store? So this could really bite into some things that, economically speaking, if it already hasn't bitten into people. All right, the non-farm payroll change, really, it was up, so that's positive, but way down from what they had expected. Factory orders on a year-over-year basis are now declining. This is also showing some economic weakness. So the unemployment rate just boom, and I haven't even been able to go on Twitter or X, or I'm sure everybody's just going to be freaking out about this one. And then we put all of this together with the initial jobless claims in red, the continuing claims in blue, and then the unemployment rate now. This makes it a little bit easier to see. So yeah, we'll just keep an eye on this and see how it goes. All right, Isabel Net, junk to A-rate bond spreads. Now we measure something. This is when I say risky to not as risky bonds. There's not a lot of risk right now. Now, all of these charts that I'm going to show you are before Friday's session, okay? But they were after Thursday's session, which was also down as well. But this is just suggesting there's not a lot of fear in the bond market, at least yet. Okay, the inflows, where we're seeing a real drop-off. Now, we're not seeing money going out, but we're seeing enough of a drop-off so that the 12-week moving average is starting to roll over. Then looking at the ISM manufacturing, which came out, where we are declining with the purple line, that's the S&P, and we're also declining here with the ISM manufacturing. And it's below 50. That means that we're showing a contraction economically right now, another concern for the market. All right, then exposure to equities. As we've been under pressure lately, we're seeing this coming down. It's probably going to go down even more. Then I'm not quite sure if this is useful or not. It says the VIX average trend in U.S. election years from 70 trading days. Well, we're like 93 days away from the election. I actually went and looked. So this chart really doesn't even apply. This measures 70 days going forward and then what the VIX does. And then it says the VIX tends to bottom mid-late August and trends up through U.S. election day. And then they have the average trend. Why they singled out Republicans here, I'm not quite sure. So I don't really know how useful this chart really is. Okay, then the equity allocation is now at 62%. It's probably going to go down a little bit if the market continues to be under pressure. And then, man, 18 trillion in cash. Well, before the COVID lockdowns, they were 13 trillion in cash. Now, this is, I've been seeing other charts and reading other things that say, well, everybody's wiped through their savings. It's all gone. But according to this, yeah, it's actually been going up. And then bearish surveyed sentiment. This just looks at the bearish side of things. That's why I didn't include it in the sentiment section. This takes the American Association of Individual Investors and Investors Intelligence. And at the time this was prepared, it just shows the bearishness is really low. This is probably going to spike up from here. And then the risk appetite indicator, all right, we're coming back down to a more neutral area as the market has been under pressure. I couldn't get to a lot of this stuff to really see anything here, but this is a pretty scary looking chart where it all really started on Thursday, where we had a higher open and we went up, we hit some resistance, and then bam, it's like 55.50. That was like ancient history now, where we just really came down. We did see a little bit of a bounce going into the close, but then we had those earnings come out, we gapped lower, and then we just came down to S2. And it looks like we set up a pretty good base here. And this is around the 100 period moving averages. So and we were able to at least stabilize at this point and then come up a little bit off of that going into the close. But we were at 55.50 after Wednesday into Thursday. Now we're in the 53s. So yeah, it's been quite a drop. And then here it just shows how the futures were negative here. This was the drop after the earnings reports came out. And then they were trying to claw their way back a little bit. And then everything just went kablooey. And you can see, okay, I'm looking at the wrong day. So here are the earnings reports. They really didn't do all that much. And then everything, as we got into the pre-market session, this is when everything really started to fall apart. And there was a bit of a reaction to the employment situation report, but it wasn't all that drastic. I mean, it just kind of fueled the downward move a little bit more. Okay, we are still seeing where both value and growth have been declining, but the red line is on top, the blue line is on bottom. That means value is still outperforming growth on an intraday basis. And we're continuing to go down as growth has been underperforming value intraday. And so growth was down a whopping 2.11%. Value got hit too, but it wasn't down nearly as much. And the mid caps were down over 3% with growth, and small caps. I mean, where's the love for the small caps? The growth was down 3.58%. So looking at our charts, it actually went up a little bit, but not really showing any strength right now. And we're seeing a death cross here with this ratio. We continue to fall, and we're also in a downtrend here when we look at mid-cap growth to value, and we're also going down, but we're still in an uptrend with S&P growth to value. This is encouraging, and this is something that we're watching. We're watching the growth to value ratio between these two ETFs, where we have still stayed above the 250-day moving average. We have not fallen below that. Even with the decline that we saw Thursday and Friday, we're still above this. So let's see if this ends up being something. All right, discretionary to staples, not doing very well right now. Large cap growth fell below its 50-day moving average, now coming down and closed just slightly above its 100-day moving average. And the ratio between large caps and small caps, well, small caps got hurt a lot too. So this ratio is actually going back up a bit now. And we fell below the 50-day moving average. This was hanging in there. This is a broad market measure that we use. We were able to stay above the 50-day moving average. We dropped below it on Friday. All right, looking at our trend, the red line is going up. The ADX is turning up, but it's not above its moving average yet. And the green line is declining. So this is intermediate term negative for the trend. We're also turning up, but not above the moving average yet. This is also showing that we're in a short-term negative trend. And we are picking up here with volume. And we're supposed to be really light on volume right now, according to this chart and this chart. But there's really not too many people that either they're on the beach doing all their sell orders or something. Volume has actually been pretty robust. And the ulcer index is really going up right now, showing there's a lot of fear. And we went up with the 1-day equity put call. We're going back up now with the 5-day, and we're continuing to go up here with the 10-day equity put call ratio charts. And look at the VIX. My goodness, we broke above 20. This was a real shot up here on a closing basis. And even though we closed off of the high, we got way up almost to 30 at some point here. I mean, that's massive. So a really big move with the VIX. And we also saw the VIX of the VIX really spike up as well. And of course, the momentum for the VIX continues to be up. And we're also extreme with the VIX, using the RSI 9 here to measure the momentum. And this is what we typically see right about now. It's not necessarily a surprise based on seasonality and the history of what has happened about this time of the year. But this fear gauge, just a little blip up, not too much. That's because this is 3 to 7 year bonds and investment grade bonds. Well, interest rates are going down. So there's not a lot of fear increasing that way. They're just, interest rates are dropping, but this did tick up a little bit. Where this other one, this is short-term bonds to the equal weight. Man, it's just really spiking up right now. Okay, the risk on to risk off. Yeah, it's going down as people are getting out of their risk on positions. And if they're doing anything, either getting into cash or getting into more risk off defensive type positions. And we're still pretty low here with the volatility risk premium. It ticked up, but we're still below the band. Okay, advanced decline line. Now, this is kind of encouraging, but kind of discouraging at the same time. We came down based on price, but it's not falling off a cliff, at least yet. But look at how we're still seeing that negative divergence between price and volume declined a lot more than price. We're also hanging in there here. We had more new highs, a little bit of an expansion of new lows, but this internal measure is still hanging in there for the time being. We're going sideways with the 5-day, and we actually turned up a little bit here with our 10-day. Woo! And we declined, but we're still above zero with the advanced decline ratio. We're getting extreme here with the accumulation distribution. We're getting kind of far away from the moving average, and we're below a declining moving average at the same time. So this smart money indicator is negative. We're also negative with the Chaikin money flow and possibly getting extreme negative. This is one of the lowest readings we've seen over the last year. And the Chaikin oscillator actually ticked up a little bit after being extreme negative. All right. So the cumulative advanced decline line for the NYSE fell well below its moving average, coming down, but still above the moving average with our regular NYSE advanced decline line. Also came down, but not, it's not falling off a cliff, at least yet, with our other NYSE advanced decline line. And we're seeing a real drop off here with the NYSE common stock based on price. It fell, and we're falling with a bit more velocity here when we look at this based on volume. And we're coming down also based on price and volume, where volume is leading the way when we look at the S&P cumulative measures here. And we still have the NYSE holding up better than the S&P right now. And we're still positive here with the new highs minus the new lows. The daily score was still positive. It's coming down, but it was still above zero. And even though we're declining with the advanced decline lines, we're still above the moving averages with all of these different indexes. Short term, yeah, look at the volume really go through the roof there. And we fell below the 50-day. And we came down almost to this previous pivot point here. Then looking at the rate of change, where it was kind of extreme from Wednesday to Thursday, well, it's even more extreme from Thursday to Friday, meaning that we've gone down pretty far, pretty fast. So we are extreme with the Stochh RSI, the Williams percent R, the CCI 14, and the CCI 20. And we're going down with the 20, 50, and 200 period moving averages. Okay, short-term stochastics, extreme negative. Rolling over in the intermediate term, still trying to go up in the long term. Okay, looking at the state of the 20-period moving average, not looking really good right now. We have both lines going down and prices below both of those lines. So we look at the 20-period moving average, which is now in the rear view mirror, by the way, and we're well below that. And we're getting a little extreme as we're going down quickly with the boom indicator. This measures how far away we are from the 20-period moving average. We're declining below the midpoint from the 50, and we're declining but still above zero when we measure from the 200. Okay, not extreme here with the standard deviations chart. We're still in the -2 channel. We get extreme when we go into the -3 channel. And the force index, though, it is extreme negative. Intermediate term, balance of power is negative. Go, no go is suggesting you don't go. And we're down here we're actually dropping below the lowest low line here as things are turning more negative. And this is a chart that I've been waiting to kind of break out. Well, not really waiting, because that would mean we're declining, but these are anchored moving averages, which are different from regular moving averages. And I have some of these, and I go through them. This chart mainly I would talk about in the deep dive video every week, because I really didn't have anything to show. Well, I broke this out, and this is from the low that we set in April. Then here's another little bit of a fallback that we saw end of April, beginning of May, and just extended some moving averages going forward here. We broke through the orange area, and we're coming down and actually starting to break below the blue area. Where we're going to get a little bit more concerned is if we come down to this purple area, and we'll really get concerned if we come all the way down to this red area. Okay, TTM squeeze is still negative and declining. And we are looking extreme with our rate of change going back 20 periods. Doesn't mean we'll stop here. It may slow down a little bit, or this could continue to decline even further. Standard deviation picking back up a little bit after it had been declining. That means we're moving pretty fast. Ease of movement looking negative and maybe extreme negative now. The Erin is also negative. and we dropped below zero with the S&P McClellan oscillator. So now we're finally starting to turn down with the summation index based on price. We were already declining here based on volume. And we dropped below zero with the NYSE McClellan oscillator. So now we're starting to roll over, very hard to see, but this did tick down both based on price and volume. And we're positive here. Well, we're mixed with this. We declined, but we're still above zero based on price. We were turning positive and going back above zero. Now we have fallen back below zero based on volume. A bit more of a negative divergence that we're seeing here. All right, momentum is clearly negative with the PMO, but we haven't quite crossed below the moving average based on price, where we have already been in a decline based on volume. All right, so the PMOs that are rising are declining. The buy signals are going down, and we're rolling over here with the PMOs that are above zero. And we've gone from neutral to red below this longer term. This is a MACD that's on here based on 65 periods. It comes with the Elder's Impulse system, so I just keep it on there. We're negative. And this is the weird one, okay? So we had enough of an up move on Thursday to put a dot underneath. And I'm posting this all over the website, and then I said it in the video for Friday. Beware, beware, beware. Well, with the big move down, the dot was on top. In recent memory, I don't remember this happening. Usually these dots stay one way or the other for quite a while. So this is an anomaly. It's not something that usually happens. But this is based on the S&P 500. Now look at the next chart. This is the SPY. I don't have a label on here. We're still positive, and this is crazy. Look at, we're below the dots, but the dots are still underneath saying that we're positive. Now, the reason I don't do an awful lot of analysis on the SPY is because it's a derivative of the S&P 500. There's supposed to be a one-to-one relationship between the two, but it doesn't always work out that way. And so there can be some skewing, as what we're seeing right here. So that's why most of my charts are the S&P 500. But we just want to make note of this. We'll see in Monday's session if this is going to actually change over to negative. Okay, the slope oscillator is declining and getting extreme negative. We're crossing below zero now with the MACD and declining. All of our oscillators on all the different time frames continue to be declining, getting a little extreme with the slope, just crossing below the midpoint with the TSI, crossing below the midpoint with the MACD. We're still above the midpoint with the PMO and the PPO starting to cross below, and we're clearly negative in the long term here. Looking at the condition of the 50-period moving averages, we never were able to get back above them, and the red line is now starting to drop below the blue line. It moves faster. So this is showing a deterioration of the intermediate term trend. And here is the 50. Oh, what memories there were hanging out at this place. Now we were able to drop down below this, and now we look at the next chart, which is the 100-period moving average. So far, this is providing support. Is that going to continue, or are we going to fall down below this? Now, you can come up with any kind of moving average you want, but I go to the 200s after this. Yes, I look at some 150s, but for me, it's 20, 50, 100, and then 200. That's how I do things. All right, looking at the Sean trend meter, it's going down and more neutral now, and we're back down to the 100-period moving averages. Haven't been down here since, well, we got kind of close in April, but we never quite touched them. And we did see a decline, but we're still above 50 with the bullish percent index for the S&P. Also, this had really been looking good even after Thursday's decline. Well, we're still positive here, but we saw a real drop-off with the NYSE bullish percent index, and we're looking more negative with the NASDAQ 100 bullish percent index. The money flow, which was dancing above and below 50, it's now below 50 and declining. We're actually going up with the ultimate oscillator. Go figure. Okay, the vortex, the red line is going back up. That is negative. We're starting to come down to the moving average with unbalanced volume. Haven't done that since we saw the breakdown back in April. This could be turning things more negative. The Copic curve is also negative. And what do you know? The mass index. This could be getting ready to tell us something. I don't show this chart because it doesn't tell us very much very often. We crossed above the red dashed line. Now we're going above the blue line. The next signal, that's 2 out of the 3 signals. The next one is when we come back down and cross below the red dashed line again. Whatever, now, I'm not saying this is what will happen, but this is what this indicator tries to measure. is that whatever's going on at that time, the mass index is predicting a reversal. So if we continue to go down and this rolls over and comes down below, it's suggesting that maybe we've hit a bottom. I wouldn't rely on just this indicator. There's been times when it's given us some good signals, but it's also given us some very bad signals too. Okay, the Pring bottom fisher, which generated a buy signal, and then we started going down. Now it's actually going away. So I'm going to drop this chart after this video. And we're just a little bit below the midpoint here with the stocks above their 20-period moving averages. We're going down with our steady. We're declining, but still above 50 when we look at the 50-period moving average steady. And we're still positive with the 100 and the 200, even though both charts did decline. We're below 50 with the RSI 14 and 9. And we're coming into the cloud. Okay, we're coming into the Ichimoku cloud here. Here's a little better look here. We're inside the cloud. I had been showing this chart before because the blue line was dropping below the red line. That's what I was trying to point out. Now we're coming in here, and sometimes this cloud will provide an area of support. We're also seeing this longer-term green line declining as well. So this chart is not looking very positive at the moment. And we're still looking good here. Broad market, 5-day moving average of the highs minus the lows, declining, but still above zero. And then looking, this is negative now. We spent a number of weeks above this R2 level. We've broken down below it. This is a weekly chart of the S&P 500. And this is very long-term, either support or resistance. Well, it provided a little bit of resistance. It didn't provide any support, and now we're falling back down. Okay, just keeping the fib charts up here in case we continue to fall even more. And we're down below the 38.2% fib extension for the S&P. And we're negative here with the hike in ASHI going down. The KEGI is going down. The Renko chart is negative, and the three-line break is negative. And we had some 3 zeros in here in the point and figure chart. Enough, get a load of this dance. A double bottom breakdown. Now, doesn't that just make you want to just go hit the floor and show your moves? But this is looking more negative now. Now, point and figure chart, it does not take time into account, nor does it take volume into account. And so this just looks at price, and it's looking more negative at the present time. All right, long term, we're no longer extreme at the 150, and we're just ticking a little bit below this level here with the 200. But this is the 10-day average of the highs and the lows for the S&P. We're coming down, but we're still above this green line. So it may fall, but it hasn't fallen yet anyway. And we're negative in the short term on all the different indexes that we follow. So we're negative in the short term with stocks. We're negative in the short and intermediate term with commodities and the dollar. Bonds are actually, because they're going up as interest rates are going down. And no change here in the decision point scorecard, even though there should be. Awful lot of red. We had real estate hit a 52-week high. It likes the declining interest rates, but awful lot of red here. Very negative things happened in Friday's session. And we saw staples and utilities. These are two defensive areas. Now, utilities were kind of at a question mark with that, wondering if utilities have been going up for other reasons, more for growth, like for AI and for all the mining that needs to be done for Bitcoin and all the cryptos. All the other sectors ended up being down, with discretionary leading the way lower, and then tech. Energy was also down as well. All right, then looking at the equal weight versus the S&P, the equal weight's holding up a little bit better here. And when we come down like this, that means that the equal weight is doing just a little bit better right now. So it didn't necessarily fall apart. Came down to S1 with the Dow, and we're able to bounce up off of that. So still above its 50-day moving average, but we're negative with the Elder's Impulse system. NASDAQ breaking below support, was not able to get back above support, below its 50-day moving average, still above its 200-day moving average. Similar here, but we closed pretty much right on this pivot point for the NASDAQ 100. Is that going to be a support level that will hold? But we're negative now with the QQQs, with the Elder's Impulse system. We are negative and possibly even extreme negative with the momentum of the NASDAQ 100. And we're falling down here, and we're watching the blue line rolling over, potentially crossing below the red line. That would be the 20 period dropping below the 50 period. And we're coming down here almost to a full retracement now with this fib extensions chart for the QQQs. Small caps going to the moon? Well, not so much. Closed off their lows, you can say that, but down 3.36%, continue to be negative, and that gap is not a good thing to see. And here looking at the Russell 2000 small caps, dropping below 50 with the RSI, still above the 50 period moving average here based on price. Momentum as though switched over to negative. Mid caps closed below their 50-day moving average and slightly above this pivot point, and remain negative here with the Elders Impulse system. And this was another area of hope. We had been holding out above or at the 50-day moving average with the total U.S. stock ETF. Well, we dropped over 2% on Friday, and we've given up the 50-day moving average. Okay, the staples to tech ratio, it is shooting up right now as staples are holding up better right now than tech. Financial sector, it declined too, but it's just coming down to its 50-day moving average. The dollar really dropped off as well, but it's still in an uptrend on the daily chart. The FANG index was never able to get back above its 50-day moving average and now down 2.87% on Friday. Apple was up 0.69% and above its 50-day moving average. Amazon was down 8.78%. Oops, it dropped below its 200-day moving average. Microsoft's coming down to its 200-day moving average. Meta was down 1.93% but just slightly below its 50-day moving average. Google was down 2.4% in between its 50 and 200 moving averages. Nvidia was down 1.78%. Almost seems like a small loss there. Tesla coming back down to its moving averages, down 4.24% after we just started to see a golden cross. Netflix was down 1.79%. It must have been that movie that I watched that I didn't like. All right, and then we're looking at the ratio between the small caps and the tech sector. This had really been shooting up as the small caps were outperforming. Not too much of a decline yet. We'll just have to see if things continue to show more favor towards the small caps. All right, looking at U.S. versus international stocks, dropping off in the short term, lengthening in the longer term relationship. We really dropped with the 10-year yield, and we were up with the 10-year based on price. Ooh, man. But our growth to value ratios, going down with the Qs to S&P, down with discretionary to the S&P. Large cap growth is underperforming large cap value. So the large caps, mid caps, we saw a little bit of a tick up, but below a declining moving average with the small caps. And we're still going down with the S&P to utilities ratio, which is negative. And now sometimes this is positive. When we spike up with the 2-year yield and then come down, that often gives support to the S&P. But if the market is really concerned about this economic weakness that could be coming in, then we're also going to be watching some other charts, the 3-month yield on things. And I go through that in the weekly, either the weekly or intermarket analysis video. All right. Positive and negative here with the advanced decline ratio. We're still above 0 based on price. We're below 0 based on volume. And we're going up here with the Staples to S&P ratio. That is negative. Did we get a Hindenburg confirmation? No, not yet. But remember, there's a day lag here, and we're not going to get Friday's reading until after Monday. But we have a confirmation here, and you can bet the Perma Bears are just partying. Oh boy, they are probably so excited right now. And I can just read their newsletters now, just patting themselves on the back and just thinking it is just party time. We do have a confirmation here, but look at all the other confirmations we had and nothing really happened negative after that. But we have to pay attention to this nonetheless. Okay, what's our outlook for Monday? In the past week, we had about 35% of the S&P 500 companies report their earnings. And these were like Meta after Wednesday, Amazon and Apple after Thursday. We are now negative and we're down to the 100 period moving averages. We're going to get, this should have been changed. We don't have, well, we do. We'll go to the, I had to do everything different because of not having any internet here. And obviously this didn't get updated. And we want to keep an eye on the geopolitical things. This is the economic calendar, where on Monday, we're going to get ISM non-manufacturing, which means services. So that's kind of the big one coming out there. And here is all the expectations for what happens on Monday. Seasonality, we're neutral to positive, though. Not really much of an edge for August 5th. but seasonally, we do look a little bit better. Oh, the memories. So long ago on Wednesday, July 31st, all the positive things. I'm not going to go through this here, but this was put out by Stock Traders Almanac, and they were just talking about how wonderful thing is. But I mean, to be realistic here, they did say more volatility ahead, September to October, weakness. Well, tell that to August. Rate cuts. Is that going to be good, or now is that going to be negative? So anyway, if you want to look at this, I've been going over this already. Okay, Monday is the most positive day of the week. Based on what happened in 2023, we'll see if that means anything on Monday. And then we have the year when the president is not running for re-election, still ends up being positive. And we're still positive for August, seasonality-wise. It's September when things can really get ugly. And this also shows how September can be not very much fun. But during an election year, August tends to do about the best, probably because of the conventions that are going on. We've already had the Republican one, the Democratic one's coming up. All right, so the warning signs. We're watching these defensive sectors, and we've been watching them now for quite a while. Growth to value, discretionary to staples, they're just not helping things out. Both the 5 and 10-day equity put call ratios are going up. We're looking extreme with the accumulation distribution as well as the Chaikin money flow, but we're actually going up with the Chaikin oscillator. Go figure on that one. And we've turned back to negative with the S&P and NYSE McClellan oscillators. They both dropped below zero, which means our summation indexes are now starting to go down. Parabolic SARs turned back negative, but not with the SPY. And we're seeing mixed signals with the Swenlin trading oscillator here. Positive on price, negative on volume. Ease of movement is negative. The money flow, vortex, our oscillators, the ultimate oscillator, even though it's going up, go figure. And the Copic curve is still negative, and the momentum, possibly extreme negative with the NASDAQ 100, and the bullish percent index is negative. Positive signs, kind of a short list right now. Bullish percent index for the S&P, but it is declining. The advanced decline lines, this is actually, at this time anyway, kind of reassuring. They're declining, but they're still above their moving averages. We're not seeing a total breakdown, at least yet. The bullish percent index for the NYSE, even though it declined, has still been holding up quite well. And the financial sector came down to its 50-day moving average, but still hanging in there for the time being. Okay, our conclusion, we are negative and we're down to the 100-period moving averages. In the short term, we're negative. We're well below the 20 periods, and we're getting oversold. We have a pretty long list. Intermediate term, we're negative and down to the 100-period moving averages. We're still positive in the long term. We're no longer extreme, but remember, the big picture remains positive, at least for now. Thank you. I really do hope you have a great weekend, and I will talk to you in the next video.